Hello and welcome to ThePrint. I'm TCA Sharad Raghavan, Deputy Editor. Now, yesterday I had done a video on the 5 top gainers and losers in 2024. One of the gainers in that list was the banking sector, and I felt it was important to highlight just how good things are looking, and that's what I'm going to be doing in this video. The ratio of non-performing assets across banks in India fell to at least a 13-year low of 2.6% in September 2024, the latest RBI data shows. Notably, this strong performance has not solely been driven by write-offs of these loans, though that has been one of the major reasons. There has also been a substantial slowdown in the addition of fresh bad loans. The RBI said that the improvement in the asset quality of banks started in 2018-19 when the gross NPA ratio, which is a measure of bad loans in the system, had peaked at 9.1% for all scheduled commercial banks and 11.6% for public sector banks. Since then, the gross NPA levels in absolute terms and as a percentage of total loans given out have steadily fallen. For instance, gross NPAs of all scheduled commercial banks by the end of March 2019 stood at Rs 9.4 lakh crore, amounting to 9.1% of outstanding loans. This fell to Rs 4.8 lakh crore and 2.7%, a 13-year low by the end of March 2024. The RBI report says that the preliminary data shows the ratio would have fallen further to 2.6% by the end of September 2024. Similarly, for public sector banks, the gross NPA level fell from an absolute value of Rs 7.4 lakh crore and a ratio of 11.6% in 2018-19 to Rs 3.4 lakh crore and just 3.5% in 2023-24. The RBI's reports have been providing a reason-wise breakup of the reduction in NPA levels since 2021-22. The data shows that the single largest reason for the reduction in NPAs since that time has been because of loan write-offs. A loan write-off is a technical requirement under which banks, after they have made adequate provisions, take the bad loan off the asset side of their balance sheet and report the amount as a loss instead. The recovery process of the bad loan continues, unlike with a loan waiver, under which banks cancel out the entire loan amount. The RBI data shows that of the Rs 3.75 lakh crore reduction in gross NPAs across all scheduled commercial banks in 2021-22, Rs 1.79 lakh crore or 48% was due to loan write-offs. This share rose to nearly 57% by 2023-24. The rest of the reduction was due to recoveries or the upgradation of these NPAs once their repayment cycle restarted once again. Among the public sector banks, the share of write-offs in the overall reduction of gross NPAs increased from 56% in 2021-22 to 65% in 2023-24. Now, an important point that comes out in the data is that while write-offs remain a significant reason for the reduction in the NPA levels of banks, the other major factor driving the trend is that fewer loans have been turning bad lately, both in absolute terms as well as a percentage of total loans outstanding. The overall banking sector in 2018-19 added bad loans amounting to Rs 3.14 lakh crore, which increased to 4.01 lakh crore in 2020-21, the pandemic year. Since then, this figure has been steadily falling till it reached Rs 2.13 lakh crore in 2023-24. The RBI also provides data on the slippage ratio, which is basically fresh bad loans as a percentage of the total loans outstanding at the beginning of that year. The lower this ratio, the better it is for the banking sector. The slippage ratio has consistently fallen since 2018-19, from 4% that year to 1.5% in 2023-24. The RBI further notes that in this regard, public sector banks have outperformed their private sector peers. It said that for the third consecutive year, the slippage ratio of private banks has remained higher than the public sector banks. So the overall picture is this. Bank NPAs are at historically low levels. The NPA crisis of the past seems to have been effectively dealt with. Loan write-offs are still a major reason for NPAs falling, but another important reason is that now fewer loans are turning bad. But on that note, that's all from me. Thank you for watching and a happy new year.